Hi, Stuart Bruce here, and I am the Spare Time Property Investor. In these podcasts, I'm going to share tips, tricks and lessons that I've learned and will hopefully help you, especially if you're still working the 9 to 5. Hello and welcome to another episode of the Spare Time Property Investor podcast. And today I'm talking about property investment expectations versus reality. Before we get into it, thank you again for joining me. If you find this episode helpful, please share it on your socials. Please like and subscribe. It all helps this podcast get out to more people. So the reason for me recording this episode is because from speaking to a lot of people, the people I interview and meet in the property world, there's a real common theme that when you first start looking at property as a way to make money or secure your future, you get bombarded with all these promises about what will happen if you buy someone's course, for instance. And there's often a promise that you'll be able to replace your income within 6 months or a year. And generally there's an image of somebody with a massive watch, a fast car, maybe on a beach somewhere, living a life that a lot of people probably aspire to live. So how does that image match up with the reality of property investment? And these people are great at selling a dream. They have the image that people aspire to. So off the back of that, they sell really expensive courses sometimes, or at least get people excited about investing in property. Now, some people go and buy the courses, they get involved, they spend quite a bit of money, and with the understanding that by doing the course, they'll get to that dream life a lot quicker. Other people spend a lot of time reading and listening to podcasts to figure out their own way through. And in all honesty, I've met lots of people who have done the courses, spent a lot of money and say it did wonders for them. And other people, equally successful people who didn't do anything like that, just read, got stuck in, made some mistakes along the way, who didn't do the courses. So I don't think there's a clear right or wrong here. And I'm not saying that anybody should or shouldn't do courses. But it's definitely an image of life that people live when they start investing in property, that people aspire to, and expectations about what you will be able to achieve when you start investing in property. So let's run through some of those popular expectations that are bandied around so often. So first, a really popular one, that you can replace your income and quit your job. Yeah, you can absolutely replace your income. There's no doubt that is possible. But sometimes what's not made so clear is that you need to account for things like void periods. You need to account for things like tenants not paying the rent, expensive repair jobs, tax, and also growing your portfolio, because you can absolutely replace your income. But if you replace your income and then step out of your job, the lenders are probably going to run a mile when you go to them to get that next mortgage. Yeah, so yes, you can absolutely replace your income, but it's a little bit more to it, and there's some kind of bigger planning to make sure that you're making the right decision in terms of once you've replaced your income, when is the right time to quit your job so you can carry on building your portfolio to the size that you want. The next one, property investment is passive. Well, it's more passive than turning up to a 9 to 5 job, but it's definitely not passive. At the start of your journey, you're most likely going to get your hands dirty unless you've got a lot of money to start investing. And even then, if you did have a lot of money, actually being hands-on and getting to know how things work is really invaluable. And it will make your money go a bit further so you can build your portfolio a bit quicker. Then there's the IKEA runs, there's the runs to B&M or the Range or wherever else, just to get those bits and pieces you need to get the house ready for tenants. Then there's things like mortgage applications, remortgages. This is all going to fall to you. This is all paperwork. Dealing with paperwork you need to send to company's house, tax returns, all those bits and pieces. It adds up. So it's not entirely passive. It's more passive than turning up to a day job, definitely, but there's still a lot of work there. And even if you have a great letting agent, you'll still have contact from the letting agent from time to time to approve things that they need to do. And if you're building your portfolio, again, you'll be involved in the acquisition of properties, making sure they work for you, making sure that the numbers are as good as you want them to be. So it's more passive than a day job, absolutely. But depending on how quickly and how big you want your portfolio to be, there's definitely some work to do, and there's some ongoing work to do to manage that portfolio and the individuals within your power team. The next one, that you can and need to buy below market value. Now, this is all about building your portfolio, isn't it? Being able to buy a property that's below market value, and then once it's up and running, you can remortgage and pull a good chunk of your money out to go again, which is fantastic. But sometimes those properties that are below market value might be in a less than favourable location. So longer term, that might not give you the returns you might want. A few years ago, I heard somebody say when they were looking at properties, they wanted good value, not cheap. And I think that's something really key here. I know in our area, there's definitely some places we could buy very cheap houses, but actually we wouldn't, because they're not in a great location. The tenants that would be attracted to those locations would probably be more difficult to manage. There would definitely be a lower rent that we would achieve. So over the long term, even though we would be able to buy a house that's cheap, not necessarily good value, it wouldn't pay off over the period of owning that property. Houses are going so quickly at asking price or above, so the likelihood is, unless you're doing a direct to vendor campaign, you're not going to get below market value properties. But that doesn't mean to say you can't get good deals. And especially if you have a strategy to add value by extending, or if you invest in HMOs, for instance, you can definitely push the value of the property and the income you can get from them. So if you decide to wait for that unicorn deal, which is 25% below market value in a fantastic location that would rent out all day long to the perfect tenant, you'll probably be waiting for an extremely long time. Now, if you have money sat in the bank waiting for you to invest, that money's not doing anything for you while you're waiting for that amazing deal. And also you'll be passing up good deals that would work just fine. Now, this episode is all about expectations versus reality, but I just need to throw in that the easiest way to deal with this issue is by having a deal criteria with a return on capital employed you're happy with. Then you can stack deals against that criteria. Then if they work according to your numbers, even if they're not the absolute perfect deal, you'd still be wise to pursue those deals instead of waiting for that unicorn to come along. Then related to the last point, the expectation that you can recycle all of your money out of each deal. Now, it is possible to recycle all your money out. We've done it a couple of times, but it is difficult. And it's more difficult at different times in the market cycle, especially if people aren't so motivated to sell you their house below market value. You can add a lot of value to properties if you know what you're doing and recycle some of your money out, and that's fine, especially when you start building up your portfolio, because you'll be able to combine some of the capital raised from refinancing one property with the rental income from other properties, then combine to give you the next deposit to, build your portfolio. And again, this is another great thing when you're able to do it, but it might not always be possible. And if you wait for properties that you can get all of your money out of, you might very well pass up perfectly good deals. Now, this is a really popular one, the expectation you will be able to invest in property without using any of your own money. Now, it is possible, and especially if you get into rent to rent or you source properties, which isn't really investing in property in all honesty. They're businesses related to property investment. But there are definitely people who are great when they get on the phone who are able to secure rent to rent deals, for instance, which is fantastic. And you might be able to persuade a family member to lend you some money for the refurb, for instance, or persuade the landlord to give you a rent-free period up front to get you up and running, and use the first month's rent from the tenants that you find to pay for the first rent to go to the landlord. You can do all that you can do all of that, and it will help you learn about property investment, and then you can switch from that to buying your own properties and building your portfolio. So that is absolutely possible. You can also source deals to other property investors to build up your pot to start investing, and this is all possible. So this is definitely possible, but what you have to be aware of, it has a low barrier to entry, which means that anybody can put themselves out there as a property sourcer or start contacting people for rent to rent. So it's massively competitive. And from the advertising I see on Instagram and Facebook, people make it seem like you'll be able to replace your income from these methods very quickly because you don't need to have a pot of cash of your own. But it's very, very competitive. So I'd say it'll probably take you a lot longer than you're led to believe. Or you could persuade somebody to give you the money to start investing in property, do all of the work, spend all of the time on it, but you'd probably have to have quite a lot of track record somehow to be able to persuade that person you're a safe bet. So going back to that initial image of a guru with a big watch and a fast car, once you've started getting into property, you've got 2 or 3 properties, you'll more than likely be much more interested in getting your next buy-to-let or HMO than spending your cash on a big watch or a fancy car. Because it is exciting and it is interesting, and overcoming issues and solving problems is really rewarding in its own right. So you might find yourself forgetting those images that first enticed you into property investment and just continuing because you enjoy it. And also, one thing you'll definitely find, and also one of the other common things that people share that they've learned since becoming interested in property, is financial education. Now, this is something, unless you have a family member who is interested in finance or property, that very, very few of us get taught when we're young. But when you start getting involved in property, you start being exposed to financial education. And again, you'll start leaning towards assets rather than liabilities. and become much more excited about the assets and financial freedom than the initial image of somebody who lives a rich lifestyle. So the gurus have definitely done us all a favour, I think, by putting themselves out there and showing this rich lifestyle, probably to sell a course, but it's enticed us in to make us think about property and our financial futures. So maybe the reality doesn't quite live up to the expectations we're all sold when we start looking at property investment. But I tell you what, it's a fantastic thing to be involved in. The community is so supportive and friendly, and I wouldn't change it. And in all honesty, even though it's not entirely passive, and even though you don't become a millionaire within 6 months, it's much more passive than a day job, and it is a much quicker way to secure your future than waiting for retirement age and drawing down a pension. So I hope you enjoyed that episode all about expectations versus reality. If you did, please like it, please subscribe, please share it. And if you want to know how we can help you build your portfolio, just get in touch, DM us on Instagram or contact us at info@coliveit.co.uk. But for now, that's it from me. Best of luck, and I'll see you again next time. Thank you so much for listening to my podcast, and I really hope you enjoyed it. If you have, please leave me a 5-star review to help other people find it, and don't forget to hit that subscribe button.